The latest population data from Statcan has been released, the Bank of Canada is cutting rates, home prices are continuing to fall, and mortgage delinquencies and distressed home sales are on the rise. That's right, folks, it's time for another Canadian news update from your old pal MillennialMoron. I've got 4 stories for you this week, and if you're a long-time viewer, it's all your favorite classic topics. But first, I want to tell you about Ghee. After turning down a bunch of sponsorship offers from online trading apps, crypto services, and AI nonsense, I thought, hey, why not just go set up a deal with a product I actually use and really like? In fact, I like it so much that currently I'm doing this promotion just in exchange for the product. If you like cooking, Ghee is a caramelized and clarified butter made in Canada from Canadian butter sourced from small to medium dairy farms. I gotta be honest, before I tried this stuff, I didn't really get ghee. I bought a jar from the grocery store to use in some Indian dishes, but it didn't really taste or smell like anything, so I ended up just switching back to cooking oil. It turns out, most of what's sold by the big brands that you see at the store is something called anhydrous milk fat, which is an industrial dairy product that's used by commercial bakeries, but is also sometimes repackaged and sold as ghee. Ghee uses the traditional process of cooking and filtering whole unsalted butter, and the difference is really night and day. When you open the jar, it's super fragrant, very buttery, kind of nutty with a little sweetness. Since I started using it, it's basically become my cooking fat of choice because it tastes and smells really good, and it's got a super high smoke point, so you can use it to cook pretty much anything. Whatever I would have used butter or seed oils for in the past, I generally use Ghee for now. By the way, I asked Varesh, the founder who I've known for years now, to send me some B-roll footage for this segment, but everything he sent me is vertical video because he does all his marketing on Instagram. Got a YouTube channel here, dude. Get me some horizontal video next time. Here he is cooking a big vat of butter at the production facility. I think it's perfect for camping or road trips because it doesn't need to be refrigerated and it can't spill or leak unless it's hot enough to melt. Also, because the dairy solids are filtered out after it's cooked, it's technically lactose-free, so if you got a sensitivity to lactose, this might be a good alternative to whole butter. Besides the original pure butter version, they've also got a line of flavor-infused ghee, which, to be honest, I thought was basically just a gimmick to appeal to people on Instagram, which I still think it probably is, but I recently tried the urban garlic flavor, and I gotta admit, I really like it. It's kind of nice to have instant garlic butter ready to go on the counter. I used it to make this garlic bread grilled cheese sandwich in about 5 minutes, and it turned out great. So if you want to try some for yourself, and I recommend you do, you can go to freshfoods.com and use promo code MORON for 20% off until the end of the year. After that, it'll be going back to 15% off. There's a link in the video description that'll add the code for you automatically. Also, since you watch this whole ad spot, if you leave a comment with the word ghee in it, I'll enter you in a draw to win some free ghee shipped right to your door. Promo code MORON. First up, Statcan just released the latest quarterly population estimates, and contrary to my expectation, we did not see net negative international migration in the second quarter of 2025. The total non-permanent resident population continued to decline, but only at roughly the same rate as the first quarter. Due to the intake of permanent residents, the overall net migration was positive, although still at a historically low rate. This quarter brings the total non-permanent resident outflow for the first half of the year to 114,000, which is pretty far off from the pace needed to hit the government's target for this year of 446,000, so unless the outflow accelerates rapidly in the last half of the year, it seems unlikely that they're going to meet that target. However, one of the permit types with the steepest decline has been student visas, and those tend to be concentrated in the second half of the year, so it's possible we'll see big changes coming in Q3 and Q4. We'll get the next Statcan release in December and some monthly updates from IRCC in the meantime, so that should give us some kind of idea of how the situation is evolving. One other interesting thing I noticed in this release was that there were significant upward revisions to the non-permanent resident estimates for previous quarters compared to the last release in June. The previous 3 quarters all saw their estimates increase by around 100,000, and when I broke the data down for this release compared to last release, it seems like it's mostly associated with people who had work permits only but no study permit. Because these previous quarters changed as well, it seems like there's been some sort of methodology change in how non-permanent residents are counted, resulting in a noticeable increase in their estimates. This is kind of important because while we've seen a net outflow of 114,000 non-permanent residents this year, the previous quarter's non-permanent resident population estimate was just increased by 123,000. So if the government's target is to reduce non-permanent resident levels to 5% of the population by 2027, and they're already behind the pace, and the population is higher than we thought it was, they may need to either reduce permits more aggressively or revise their targets. I reached out to Statcan to ask about the revisions and a few other items I thought would be of interest to viewers, and they actually got back to me the next day, which gave me time to work the response into this video. The first question I asked was about the reason for the upward revisions to the previous data, and they gave me 2 answers. First, data from the IRCC, which is the government's immigration agency, tends to be published fairly quickly but isn't finalized until later. I made a video on this same topic last year when there was an article about how immigration applications were plummeting, but it was actually just how the data was published. IRCC data tends not to be finalized until around 6 months after they first publish it. So Statcan uses that early IRCC data to model their best estimates of the actual population, then updates those numbers later with the finalized data, so we end up seeing some changes to previous numbers with every update. Second, they've been updating their methodology on how they count people residing in Canada while waiting for permit extensions. They used to use publicly available information on permit processing times for this estimate, but have recently changed to using administrative data from the IRCC to identify permit extensions directly. Next, I asked about how they count people who have stayed even after their permit has expired, which is the most common comment I get when I talk about the non-permanent resident population decreasing. The concern mainly comes from a CIBC report in 2023 which claimed that Statcan might have been undercounting by almost 1 million people. According to Statcan, they've always considered people residing in Canada while waiting for permit renewal, but updated their methodology to account for processing times in 2023, and as they mentioned already, they started getting administrative data directly from the IRCC for this month. However, that still doesn't account for people whose permits have expired, but who might be residing in Canada illegally without a pending permit renewal. So I asked about something I'd heard but hadn't been able to verify, which is that they're now coordinating with the Canada Border Services Agency to count actual entries and departures from the country to confirm whether or not people had really left. According to Statcan, they have started doing this as of the summer of 2024, and it's significantly enhanced their migration estimates, particularly for how many non-permanent residents are actually leaving the country. They finished up by mentioning that this will all be laid out in a new methodology document that they're planning to release by the end of the year. So it seems like these data revisions are being driven by a genuine effort to improve their methodology. In all fairness, the non-permanent resident population wasn't as critical of a demographic consideration until just a few years ago, so there wasn't as much reason to get into this level of detail. However, they are working to improve past and future data as they update their methods. I also just want to add that anytime I've talked to someone at Statcan, even though I'm just a small-time YouTuber, they've always taken the time to answer my questions with a thorough explanation, which I really appreciate. Next, on September 17th, the Bank of Canada cut rates again, with the policy interest rate now sitting at 2.5%. This was actually a fairly unusual move because although the bank's mandate is to control inflation at a target rate of 2% within a range of 1 to 3%, at the time they made this decision, their preferred measures of core inflation were at or above the 3% upper limit of that range, which would normally be a reason to hold or even hike interest rates, not cut. However, in their opening statement, Bank of Canada Governor Tiff Macklem cited conditions like a softening job market, declining GDP, and U.S. tariffs as reasons to cut on the expectation that inflation will fall in spite of the lower policy rate. This is the latest example of something I've been discussing in videos for a long time now, which is that the central bank is being pulled in different directions on monetary policy. They want to keep inflation under control, but keeping rates high enough to do that is difficult when the economy is already softening and households are carrying enormous amounts of debt, which are underlying problems that can't be solved through monetary policy alone. So while they can try to find the optimal interest rate to control inflation without hindering the economy, it's kind of like a Venn diagram with no overlap. In this situation, they have to choose which goal to prioritize, and it seems like they've chosen to go with economic growth this time, even though inflation on certain luxury items, like food, is still running well above the target range. However, as is tradition, realtors rushed to the media to talk about how this rate cut was going to reignite the housing market in Canada. Sure, it's the same thing they've said for every single rate cut so far, but who knows, maybe eighth time's the charm. Speaking of the housing market, the Canadian Real Estate Association released their market stats for August, and the benchmark price is continuing to fall, down 3.4% year over year. This means home prices are now down by 19.3% from the peak in 2022, and real values are down 27.5% when inflation is taken into account. As you might expect, their press release is focused on the slight increase in sales and didn't even mention the benchmark price at all this month. They also cited the potential for the market to heat back up as buyers come off the sideline due to the Bank of Canada's rate cut. Now, this is an analysis that I first did back in May of 2023, and I've been updating it every few months since then. Basically, I wanted to look for an underlying mechanism for home prices, so I combined the Consumer Price Index and the Real Wage Index to derive an index of what people could theoretically afford on a monthly payment. Then I combined that with prevailing discounted mortgage rates and ran it through the inverse of the mortgage formula to create an index of borrowing power, which is basically how much debt people can afford to carry on a mortgage. Then I calculated a ratio of the home price index to the borrowing power index to get a relative idea of what level of home prices can actually be supported by those underlying market fundamentals. A lot of places, like banks, do a similar analysis and call it a housing affordability index. Now, this ratio itself doesn't really have any specific meaning because it's all just relative quantities, but historically it's fallen into this range of 0.8 to 1. It's gone a little bit above 1 during periods of significant speculation, but usually comes back down. However, you can see that when the Bank of Canada started hiking rates in 2021, the ratio shot up to about 1.5, representing a situation where prices were way higher than most households were able to pay. For the most part, people couldn't afford to borrow enough to pay these prices even if they wanted to. However, housing prices are much slower to fall after rate hikes compared to how quickly they rise after rate cuts because people are very averse to taking a loss on real estate. So as home prices slowly fell and rates came down as well, this ratio started falling, but it's still well above the normal historical range that households are able to support, especially in the context of a weakening economy and concerns about job losses. So if my analysis is correct, this latest rate cut isn't going to result in another housing price boom because we still haven't even priced in where mortgage rates are right now, let alone what they were at their peak. That would explain why sales are still very slow. Buyers just can't afford to pay what sellers are willing to accept, and it's really not any more complicated than that. Finally, we have this article in the Globe and Mail by Hanif Bayat of Wawa.ca discussing a wave of distressed sales in the GTA. The article includes this chart showing a very sharp increase in mortgage delinquencies at RBC, and later on X, he posted a similar chart for CIBC. Now, once again, 2 years ago, I touched on this topic in one of my videos. Mortgage delinquencies had gone up a bit, but most people were dismissing it as a return to normal after historic lows. But I thought there was some secondary data that was still concerning because mortgage delinquencies are a lagging indicator, not a leading indicator. Rather than repeat myself, I'll just show you a clip. We're also seeing a slight uptick in mortgage delinquency rates, particularly on higher value mortgages. However, the overall delinquency rate still remains low at about 0.15%. Personally, I don't consider this to be a very important indicator of the direction of the market because for many Canadians, their personal residence is the bedrock of their lifestyle and finances, so the mortgage is the last type of debt they'll be willing to default on. We are seeing increasing delinquencies on other credit products such as auto loans, credit cards, and lines of credit. On top of that, we're seeing non-bank lenders such as mortgage investment corporations and other private lenders increasing their market share of residential mortgages. This is generally not seen as a good sign because usually these lenders are used by borrowers who don't qualify with chartered banks at first but are hoping to move to an A lender as they build up more equity. Instead, we're seeing the opposite trend right now. People are moving away from A lenders and switching to B lenders as they struggle to make their payments at higher interest rates. We're also seeing an increase in the risk profile of mortgage investment entities, which also tend to have a significantly higher delinquency rate than other types of lenders. It's a lot of data, but it all adds up to what we already knew. People are struggling to make their payments, and they're trying to find solutions to stay in their homes. However, based on the data for mortgages and other forms of consumer debt, it seems like the situation is getting worse rather than better. So basically, although mortgage delinquencies were still low at the time, people were missing payments on other forms of debt, indicating what everyone except economists understood, which is that households were under a lot of financial stress. Missing payments on debt obviously means you don't have enough money coming in to cover all of your bills, so some things have to slip. The problem is, if you don't solve the underlying issue by increasing income or reducing debt, the situation just keeps getting worse, just like I said in 2023. When you miss payments on things like credit cards or auto loans, you start racking up more debt, penalties get added, demand loans start getting called in, and that leads to more financial stress, not less. Once every other option is exhausted, that stress flows through to mortgages from private lenders, then eventually to mortgages at the big banks, and that's what we're starting to see now. So we'll see how the situation progresses, but I don't think a quarter-point rate cut is going to be enough to save distressed homeowners. Now, if you're interested in what people are talking about in the depths of finance social media, this situation has some interesting implications for something that Ben Rabideau has referred to as the Great Canadian Carry Trade. Basically, when interest rates were low and home prices were high, there were a lot of people profiting from the real estate market through private lending. People would borrow money against their homes at a low interest rate through a home equity line of credit, then lend it out to people who didn't qualify for a traditional mortgage, often at high interest rates like 10, 12, or 14%. They make a lot of money capturing the spread between that high interest rate and the low interest rate on their line of credit, and it wasn't seen as that risky because the private loan was secured against a house and home prices kept going up and up and up. However, now that interest rates are going up and home prices are going down, a lot of those private borrowers are at risk of defaulting on their loans and they're underwater on the mortgage, meaning that the person who lent them money is going to take a loss. The problem is, the money they lent out in the first place was borrowed against their home, which has also gone down in value, and the interest rate on the mortgage and the line of credit has gone up. So now they've got higher payments on top of a capital loss, so the financial stress of the borrower has been passed back to the lender, who might now be struggling to keep making payments on their own home. Not a great situation. So that's all for this week, but as always, subscribe to MillennialMoron to keep getting your news 2 years in advance. Thanks for watching, and use promo code MORON for 20% off.